3, 2, 1. Welcome to the jungle.
All right. Welcome to the jungle is right.
This has been crazy week for the market, man. I know you're going to get into it and tell us all about it, but holy mackerel.
Yeah. When we were putting this together a minute ago, we had Bloomberg up on TV there, and it was saying this is the worst April for the NASDAQ since 2008.
Yeah. When Jerry hit me up this morning, he obviously is looking at the market way earlier than me. You know, I usually kind of start walking into it around 10 or 11 or something, but, you know, he's already looking at futures at, 4 a.m. or whatever.
Yep.
And he's like, hey, look at the market. And I turned Bloomberg on, and it's like red. I was like, oh, man.
Yep.
So tell us what we're in for, man.
Yep.
Give us some wisdom.
I will do the best I can.
We're all looking to you for some light at the end of the tunnel.
Yeah, I wish I could kind of get across the amount of YouTube that I watch and the different opinions of really, really smart people.
Yeah.
I mean, there's a guy that I was watching yesterday that is calling for, actually I have it written down here. He's calling for a melt up.
Not a meltdown.
Well, in the next 3 to 6 months, a melt up to 6,000 on the S&P 500, 6,000, 20,000 on the NASDAQ, 45,000 on the Dow Jones, only to be followed by an 80% correction after that. So I mean, he
right. So a lot of people are going to be really happy for a while, and then all of a sudden,
yeah.
If this guy's
if his is right,
analysis is correct.
Most people, on the other hand, and I think probably what most people are hearing is the market's just going to crash. Like it's
right now.
It's already started, and it's just going to continue. And it's
for a lot of people,
crashing.
they feel like this is that 80% drop now.
Yeah.
Right.
Yeah.
And so, if you guys watch us regularly, particularly if you're members and you look at the analysis that Jerry puts out, in the weekend newsletter, you can see that we've been looking at a plan A for a while, but we've always talked about a plan B, plan C. And it looks like, correct me if I'm wrong, plan B happened.
In the short term, certainly. Yeah.
Right, yeah. And so I'm only pointing that out because we were talking about this before the show where just, I mean, we always say, everybody, we don't have a crystal ball.
Yeah. No.
But we do have plans. And so, you can't have 10 plans. That's kind of hard to track. But 2 or 3 will keep you on track. Yep. And you cannot lose sleep over not catching it at the perfect point. We're not going to do that in the TSP. Right. It's just not going to happen. You guys have to just embrace that and just own it. And if you're like, if you get mad because you lose $3,500 in your account, I'm not making light of that. I don't want to lose $3,500 is a lot of money, depending on what your perspective is. But and I just say that because I saw a comment about that on Facebook, and I'm just like, with the restrictions we have on moving in and out of these funds, you can't lose sleep over that.
Yeah.
You just can't. Now, what we're trying not to do is lose 10, 20, 30% or 80%.
Right.
We're not going to be in. I hold me to this. We will not be in the market for an 80% drop down or a 50% drop down. We're going to be out because we're going to see the trend change and we're going to get out, just like we did every time it's happened before. And we can show that going historically. We've only been doing this show a couple of years. And on our website, I think it only goes back, so far. But, I mean, the way I got into this with Jerry is that 2008, I watched that happen and we weren't in.
Right.
We were out.
Right.
All right, man, let's get into it.
So we brought back the market this week slide. We've been putting this out on its own. And we're going to continue to do that on Fridays, but brought it back into the show because it's a pretty good summary. So the week ending for Friday, 22 April, C Fund was down 2.75%, S Fund down just about 4%, I Fund down 2.17%, and F Fund down almost 1%. And somebody had pointed out that how come we never have the G Fund on there?
Yeah, I was going to say that. Like, we added the G Fund because, that's a full perspective. That's a full,
No, it's all 5
right.
TSP
and
funds.
So we always assumed people understood the G Fund always goes up.
Yep.
It goes up very, very slowly.
Well, it doesn't always go up
Well, you don't lose.
But you can't go negative, right?
Yeah, that's a better way to explain it. Sorry. But, I mean, to me, 0 is better than negative.
Yeah,
so,
100%.
So holding it is okay. But generally, you'll have this slide that we're showing. You'll have some version of this where everything else is down, but the G fund is up. Yep. Now, that's obviously not where you're going to make, massive gains,
nope.
But you have to have this in perspective.
Yes, absolutely. And that 0.57, so just to be fully transparent, I took that off the daily TSP app, and it only went through yesterday's close. So I multiplied yesterday's close by 1.2, adding 20% for today, and got 0.057. Isn't a lot, but it's only for the week. So if you multiplied that out by 52, that would be the annual rate of return if you stayed in the G fund for the whole year.
Yeah.
It's better than being negative.
Absolutely.
All right. So this one might be a little controversial, but hey, we don't shy away from that. So quote of the week, the time to buy, I missed an is there. The time to buy is when, the time to buy when there is blood in the streets, right? That's the original quote. Even if the blood is your own was kind of added to it. So the time to buy is when there's blood in the streets. We see people throw that out on Facebook all the time. You want to be buying when the market's buy on a red day, never get out on a green day. They're all kind of derivatives of this idea to buy when there's blood in the streets.
And they're basically just regurgitating what they've heard on somebody say.
Right. So
it's not really a well thought out response.
Right. So, okay, Baron Rothschild, if he's one of the most infamous people in financial history, the Rothschild family. Yeah. If you don't know the conspiracies about all that,
they've done well.
They've done pretty well for themselves over the centuries.
Regardless of how they did it,
right.
They've done well.
Right.
Yeah.
So, I'm taking this from a Forbes article. Taking this from a Forbes article. The link is right here. Baron Rothschild, an 18th century British nobleman and member of the Rothschild banking family, is credited with saying, quote, "The time to buy is when there's blood in the streets." And he should know. Rothschild made a fortune buying in the panic that followed the Battle of Waterloo against Napoleon. But that's not the whole story. The original quote is believed to be, "When there's blood in the streets, even if it's your own." This is a really contrarian investing attitude, right? The strongly held belief that the worse things seem in the market, the better opportunities there are for profit. The question is, how do you know when it's really blood in the street or just a paper cut? Okay. We get into that in detail in the weekly TSP newsletter this weekend. If you're a subscriber, definitely check it out. If you're not a subscriber, you can go to growmytsp.com and sign up and check it out. So let's kind of dig into it a little bit for one chart. Okay. CGC, Canopy Growth Corp. Okay. CGC was formerly Tweed Marijuana Inc. It's a cannabis company based out of Smith Falls, Ontario, Canada. In April 2019, Canopy was the world's largest cannabis company based on the value of all shares or based on market cap. Okay. The biggest weed company in the world. And that was back in 2019. We don't go back that far in the chart. The price back then was about $25 a share, and it ran up to 60. Somebody, there's two sides of every trade. Somebody's buying, somebody's selling. Mm-hmm. Somebody bought it up there at $60 a share in February 2001.
Yeah. Hopefully they got out quickly.
Well, let's pretend we're the person that bought it at $60 in February 2001. Okay. If it came down a third, right, 33%, so it went from 60 to 40. Okay, that's a 33% loss. Is that blood in the street?
And mark that a little bit. I know you have it written over there, but show on the actual.
His $40 a share. So it was up here at 60.
Yeah.
Right. And it was just a little bit shy of 60, but it makes the round numbers easier to explain.
Right.
So if you lose a third, right, that's at $40. So you bought it at 60. It's now down to 40. Mm-hmm. Is it time to buy?
Right. Because blood in the streets.
It's 30% off.
Yeah.
I mean, it's a huge discount. Right. How about when it continues down to $30 a share? Right now, it's half off. That's a pretty good sale if you're at Walmart, right? Pretty good. And you got a bunch of support right here at 30. Okay, we had a gap up, came down, filled the gap, started running back up. So is it a buy here at 30 at a 50% discount?
If you're day trading, maybe.
Maybe. I mean, obviously you don't know what's going to happen next,
Right.
but the question is this blood in the street thing, right? So
Right.
it comes down now to 20. 66% you lost. It's got to be blood. It's got to be blood in the street by now. We got to be past the paper cut, right? How about if it comes down to $6 a share? You're 90% off.
Mm-hmm. When are you buying it all the way down?
No, I'm saying you're watching it, right?
Right.
When is there enough blood in the street that you're going to start buying it?
Right.
Because if you said, okay, at 66% off, I'm going to buy it at $20 a share.
Mm-hmm.
When it fell to $10 a share, you lost 50% again.
Right. But from a technical analyst standpoint, right? Yeah. If you were watching this chart, if you were approaching this the way we do, you wouldn't have ever bought in there.
Right.
Because you saw no reason to buy it. From a broad perspective of a monthly, weekly kind of. Now, if you're day trading, there's probably some opportunities in there.
Oh, 100%.
If you zoomed in, because you can see some opportunities.
You can make some money here.
Yeah, there's a few places.
Oh, yeah.
Of course, that's not our world.
Right.
In the TSP or in 401k or whatever. But the point is, I was thinking like there was nothing in there that told us there was a trend change to go back up.
Right.
So blood in the streets, buy. No.
You're trying to catch a falling knife, is how they say it, right? And you don't know how low it's going to go. So if you don't have lines in the sand, you can potentially take huge losses.
Yeah.
And the other part of this is, okay, so if you were the guy or girl up here at $60 a share, that's fine. You're down here at $6. You're down 90%. So we say, okay, it's at $6. It's 90% down from its high. It has to be a time to buy.
Right.
If you buy it at $6 and it loses 10%, it's $5.40, right?
Right.
Whenever I pulled up this chart here at 3:40 this afternoon, it was $5.61.
Mm-hmm.
I mean, it probably, I don't know what was the low? The low was $5.53. You could easily buy it at $6. It goes down to $3, and you lost half your money.
Right.
Percentages is what you have to understand when you look at this, because it's the percent loss from when you bought it, not from when the high or
whatever. What's the takeaway with the blood in the streets, though? At the end of the day, that's not a reason enough to. So let's apply that to TSP, right?
Sure.
So let's say we don't know. We're not going to, pontificate.
Yep.
But we are kind of. So let's just say that we're hitting this huge crash, whatever the percentage is.
Yep.
What would be the signal for you to get out? If this is your plan, like I'm just, I'm kind of thinking out loud for folks that are like trying to figure this out. Like if you saw what happened today, where is your line in the sand to get out? Where's your line in the sand to get back in?
Yep.
Right? That's what you have to figure out, because the whole blood in the streets, hey, it's a red day, buy. First of all, Jerry and I talk about this. I have a huge issue with this because just the logistics of doing that in a TSP, right? So we all know how that works, right? That means I got to go in and change my
percent allocation.
My percent allocations for new money.
For new money, right.
To go there. That isn't an instantaneous thing. It doesn't happen like right now. And so I hope we all know that, right? So my next paycheck, X amount is going to go, like, you can't play the market that way.
Not TSP, no.
Yeah, you can't say like, oh, it's a red day, I'm going to buy. And then I know there's going to be the folks that say, well, like, no, that just means all the money that I've got going in there right now, it's buying it low. Okay, great. But, I mean, what's your plan if it keeps going low? Like, again, to Jerry's point with that chart. So where in here, let's just say that's the S&P 500. Where in here do you get out? What is your plan? Where is your line in the sand, right?
Yeah, if you don't have one, if your plan is that, no, I bought it low and I'm going to wait
until it goes back
until
up.
It goes back up.
Yeah.
I mean, if you bought it, if 33% was on sale enough for you and you bought it at $40 a share, and it's now $5.61.
Yeah.
It might never come back.
Right. And people are going to say, oh, it always comes back because it's, the larger market is what we're investing in. And I would say generally that is correct.
Sure.
We're going to have another upturn.
Right. This obviously is just for an example.
Yeah.
But still.
But it's great for discussion.
It is. And it's the biggest weed company in the world.
Right.
And in an environment where weed is becoming legal.
Right.
Right? You would think this thing would be going through the roof.
Most of the kind of general fundamental analysis there would tell you, why wouldn't I invest in this?
Absolutely.
Why wouldn't I? Well, because of, first of all, if it's a company, there's got to be things going on we don't know about.
Right.
From a fundamental standpoint. But let's get back to the TSP. So my issue with that whole idea of, buy on a red day, buy when there's blood in the streets, the whole idea is that if I was in a normal brokerage account or an IRA where I could get in and get out, and I decide, an IRA is a good example too, though. I mean, it doesn't work that way. I can't take $10K that I have sitting over here accessible and go, I'm going to buy that.
Right.
That's what they're talking about.
In TSP, you can't.
Yeah, in TSP and in 401K, like in our retirement account, I can't just reach over and say, "Oh, I see this huge opportunity. I'm gonna move $10,000 over and buy."
I mean, you can in your IRA, right?
Better.
Certainly not your 401K or your TSP.
But there's still a max.
Sure. Yeah.
I can't. I'm probably not going to be able to do 10K if I was already contributing.
Yeah,
That's my point. Is like in a brokerage account, this is a whole different story.
Yeah.
So when you guys hear this stuff on CNBC and Bloomberg and Yahoo Finance, and that's generally what they're talking about. And I think that's the big disconnect to me.
Yeah.
It really seems to me that like most of the people that are trying to manage their retirement account are listening to financial analysts that are talking about brokerage accounts.
Yeah.
Right?
They're talking about brokerage accounts, and they're talking about what's happening today, right now.
Right.
It doesn't do you any good to know what's happening right now, unless you're a day trader.
Yeah, exactly. All right.
Hopefully
I'll get off my high horse.
Hopefully that's sort of proved not proved, but put a little context around the idea of blood in the street. And hopefully Canopy comes back. All right. So we had a couple questions about inflation. So, and I think Mary had said, hey, for those of us that are under 30, we don't have any idea. We've never lived through any kind of inflation. We don't know what it is,
That was our Mary?
Yeah.
Oh, yeah. My Mary.
Yeah. So I thought it was a good topic.
That is funny. I mean, if you're below 30.
Really below 40. I mean, you didn't live in the 70s. So
yeah, probably 40. Yeah. You don't really know what real inflation is.
Right.
You haven't seen it.
Right. And inflation we're going to kind of talk about a little bit, but it's interesting, right? Because when people now, like today, when we talk about inflation, we're talking about the cost of beef going up, or, it's more expensive to put gas in your car and all that. And gas, it was a big thing in the 70s that people were talking about inflation. But that's negative. That's negative, meaning you look at it as bad inflation.
Right.
But when your house goes from being worth $100,000 to being worth $200,000, that's inflation.
Yeah.
We don't look at that as a bad thing.
Right.
When your stock price goes from $10 a share to $20 a share, that's inflation.
Right. It's all perspective.
Yeah.
It really is. And it's what we're really talking about. I know you're going to get into that.
Yeah. So then we'll just what inflation is. Inflation, the Fed, because there's all kinds of talk about that, and how does it affect our TSP? Bonus chart is going to be Bitwise, because the whole crypto space is getting clobbered, and it's a pretty good technical analysis chart. And then the 2-year weekly TSP charts. Okay, so what is inflation? Kind of like we just said, inflation is a decline of purchasing power, right? So when you used to be able to buy, a pound of coffee for $7, it's $14. Obviously, your purchasing power has decreased by 50% with respect to coffee. So a quantitative estimate of the rate, right, at which a decline in purchasing power occurs can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time, which is a bunch of gobbledygook to say that you're paying more for something that, you're paying $14 for a pound of coffee when last week you paid $7 for it. The rise in the general level of prices, often expressed as a percentage, means that the unit of currency electively buys less than it did in prior periods. Okay. Inflation is contrasted with deflation, which occurs when the purchasing power of money increases and prices decline. So, when we were talking about it earlier, I can't remember what exactly. Maybe it was monitors. We were talking about most technology. I can't remember the law. There's somebody figured out that
Morton's Law.
Is it Morton's Law? Tech. Every 7 years or something, the price of technology cuts in half or something like that. That's deflationary, right? So inflation and deflation are happening simultaneously with different goods and services all the time. It's just which ones you kind of want to focus on. So again, I don't go into the whole article, but you can check it out there at Investopedia. The key takeaway from that article: inflation is the rate at which the value of a currency is falling, and consequently, the general level of prices of food or goods and services is rising. And they use a basket because we can't just talk about monitors versus cars or gas or oil or whatever. Inflation is sometimes classified into three pillars, which we're going to show on the next slide: demand pull inflation, cost push inflation, and normal built-in inflation. Most commonly used inflation indexes are consumer price index and wholesale price index. I actually like producer price index better than wholesale, and we got two charts at the end because those were a big topic of conversation last week because the consumer price index number came in and the producer price index also came in. Inflation can be viewed positively or negatively depending on individual viewpoint and rate of change. Like we said, so on the next line, those with tangible assets like property or stocks may see some inflation as that rises the value of their assets. They see that as a good thing, right?
So just so I don't get beat up by people, I said Martin's Law or something. It was Moore's Law. Moore's Law, sorry. I have an IT degree. I should know that right off the bat. Like, wait a minute, that didn't sound right. Sorry.
Yeah, no, there's one.
It's late in the day. The coffee's worn off.
Yeah.
Give me a break.
There's one for Moore's Law.
It's Murphy's Law, which
is Murphy's Law.
Murphy's Law.
You know that one pretty
Murphy's
well.
Law is what gets me every day.
Damn Irishman. All right, so three kinds of inflation, basically, generally. Demand pull. So you want to buy the most high-speed pair of Nikes, right? They were $100. Now they're $150 because a whole lot of people are standing in line to buy them at $100. So the company says, now we're going to kick the price up to $150 because we know y'all are still going to stand in line and buy them, right? It also comes when demand exceeds capacity. So right now, for example, there are capacity problems, right? We got a whole bunch of cargo ships parked off the coast of Los Angeles that can't pull into port, right? We have a supply problem, which is hugely contributing to this inflation.
Which I know a lot of folks are going to talk about. Some of that are businesses taking advantage of the perceived supply issue, right? So there's no way for you to really know if there's a shortage in XYZ if it's 70, parts down the supply chain. You just got to take their word for it. If you're like, pull furniture, you can't get it. Maybe it's just they're charging more.
They could.
Right?
I mean, my car broke in the fall, and it took 10 weeks for me to get this part. Right. Now, if they could have charged me more and gotten the part to me in a week, that would have been awesome.
Yeah, that would have proved that there's no real. It's just a supply and demand issue.
Right.
Yeah.
But no,
some of this is real.
Yeah.
But I think a lot of people are recognizing they're just taking advantage of the situation.
There's definitely
it's still available, but that's not what we're talking about in these slides, which is why I brought it up. Generally speaking, this is not when people are taking advantage of the fact that there's a perception of this. This is just the way it would work normally.
Yes.
Demand pull, cost push built in. These are real things when, production costs more. It costs me more to make it.
Right.
then I got to charge more.
That's cost push, right? That's the next one. So the first
I thought
one,
you were already there.
No, so the first one is kind of demand based, right? Demand and supply. So if the demand goes up and the supply goes down, what gives is price, right? Mm-hmm. Price goes up. Cost push is when production costs increase, right? So the first one actually goes to consumer price index. Mm-hmm. The second one goes to producer price index, right? How much does it cost the producer to build the things that we buy?
Right. And an example of that would be housing, right?
Sure.
Where if the contracting company, the builder, if wood costs more, if labor costs more, they have to charge more.
Right. Yep. I mean, lumber commodities have gone through the roof, and lumber was a huge one. It's come off,
housing is a good a good example for this. So the demand pool would be like, there's not enough houses available.
Yep.
And demand is high, so you're gonna pay more for a house.
More. Yeah. It's pretty much that simple.
The next one is, well, building the house costs more, so it's going to cost you more. Right. The next one
is just kind of built in. So as prices rise, and it takes a long time for this to happen, but as prices of goods and services rise, eventually companies need to pay their employees more so that they can maintain a standard of living, and that cycle kind of perpetuates. That's how you get like built-in inflation.
Yeah, and if we use the housing example, that would be more so the cost push would be if it costs me more to buy materials.
Yep.
Right? The built-in would be over time, an electrician makes more money. Right. So over time, my labor costs are going to go up just because people should make more money over time, and so now I've got to raise the price of the.
That's like
product.
Normal built-in, step-by-step kind of inflation.
If everybody in your company should get a 3 or 4% raise to keep up with whatever, however you want to.
Actually, that's a good example, and maybe the government kind of drives it, because if you start off as a GS7, and every year or 3 years or however your agency does it, you get a step increase. You're not producing. You're getting an increase in salary, and the environment that you're in, if you're in the DC area for sure, the amount of money that's sloshing around increases, and so price of stuff goes up.
Yeah, and in some places that 3% keeps you up with that, and in other places it doesn't.
Right?
Yeah, and it's funny now that we're out in sort of the private sector, and me more so in a couple different aspects over the past few years since I retired, but it's amazing when I run across people that are in the private sector that have been in the government or the military that just sort of expect that increase. Yeah. And that's just not the case in the private sector. They don't, you're going to, even if you're not doing any more, you're going to continually get paid more.
Right.
That's not a thing.
Not how it works.
That's not a thing.
No.
Yeah.
All right. So like we said, consumer price index and producer price index. So consumer price index looks at the weighted average of prices of a basket of goods and services that are primary consumer needs, right? They're the stuff that we buy every day. Transportation, food, medical care, all that kind of stuff. CPI is calculated by taking price changes for each item in the predetermined basket of goods, averaging them together based on the relative weight of the whole basket. Price in consideration are the retail prices of each item as available to us as individual citizens. Changes in CPI are used to assess price changes associated with the cost of living, making it one of the most frequently used statistics that Bureau of Labor and Statistics uses to calculate it. That's the number that right now came out last week as like 8.5% was a consumer. So what the government is saying, which a lot of people argue it's more like 20%. And again, it's a basket. So you can say that coffee went from $7 to $14. That's a 50% move. Rice Krispies might have gone from $1 a box to $1.10 a box, so that's only 10%. Like, it's a basket, and so the government says the basket inflation rate was 8.5%. The other side of that coin is the producer price index. So the producer price index is a family of indexes that measures the average change in selling prices received by the producer of an intermediate good and services, right? So the people that are making the stuff that we buy. So the PPI measures price changes from the perspective of the seller and differs from CPI, which measures price changes from the perspective of the buyer, right? The PPI number also came out last week. I don't remember. It was sort of overlooked, which I thought was odd, because the PPI number was pretty high, and the CPI number got a lot of positive. The market kind of jumped a little bit because it wasn't as high as expected, but the producer price index, I think, is more important, and it was kind of high, and it just got kind of glossed over. But in all such variants, it's possible that the rise in the price of one component, say it's oil, cancels out the price decline in another, say wheat, to a certain extent. They're just talking about how a basket works. So overall, each index represents the average weighted price change for a given constituents, which may apply to the overall economy, sector, or commodity level. Okay. So the bottom line, as far as inflation goes, it can be construed either as good or bad, depending on which side of the argument you're on and how rapidly the change happens. So individuals with tangible assets that are priced in currency, like a stock, property, gold, like hard assets, they want to see some inflation because it raises the price of their assets. Everybody wants the price of their house to go higher. However, the buyers of such assets may not be happy with inflation. If you're trying to buy a house right now, you're 30 years older, you're in rough shape. I mean, it's really, housing is really expensive. So it depends which side of the coin you're on. Inflation index bonds are another popular option for investors to profit from inflation. So if you can buy hard assets, inflation index bonds. On the other hand, people holding assets denominated in currency, like cash or bonds, don't like inflation because it erodes the value of their holdings, right? Which is why the F fund is tanking right now. Investors looking to protect their portfolios from inflation, this is not TSP related, it's just part of that Investopedia, should consider inflation hedged assets like gold, commodities, real estate investment trusts.
Yeah, I mean, it's not relevant to TSP, but I think it would be relevant to those people that are looking to, and kind of what I hope over time that we're able to get people to understand is the TSP should be, first and foremost, you should be actively managing your TSP if you're in the government or military, because that is a huge portion of your real retirement.
Yep.
Right? You got your annuity, you got Social Security, and you got this.
Yep.
And this is the only thing you can actually manage.
Yep.
Right? So with that said, there's a cap as to how much you can put in there.
Right.
So if you're really diligent about your overall finances for your whole life, you should be looking at other things.
Yep.
And so that little sentence applies to that, where
Sure.
In the rest of the financial world, right, there are ways to hedge against this.
Yep.
Right, where you can say, okay, I might take a loss, but if that happens, this is going to go up, and I'm gonna hedge against it.
Right.
We're not able to play those games in the TSP, but you definitely can in other,
Yes.
and that's when you get more educated about financial, the whole financial industry. So
honestly, that is the thing that I'm thinking about the most in terms of the mutual fund window.
Bingo.
Yeah. So I'm on the edge of my seat, waiting for the TSP to let us know, to give us a look into the window, right? I'm still kind of hopeful that they'll tell us where we can see what funds are going to be in that mutual fund window before the tech refresh begins on the 26th of May and the whole thing is shut down for a couple of weeks. If not, then we'll get a peek in the window whenever it opens. But we can only put 25%, a maximum of 25% of the value of your TSP account into the mutual fund window. There's a whole bunch of fees associated with it, but if the market is still declining, if you can find funds within the window that are going up if we could have been in that window now, buying a basket of commodities you definitely would have offset some of the losses from TSP if you could have done that.
Yeah,
so,
if we're able to use that mutual fund window as a tool for those kind of things, whole different scenario.
Right.
But we don't know yet.
We don't know.
We don't know. We don't know until it happens.
It's going to be. It's going to be a little beta test we're going to do, and I'm kind of excited to do it because no one else is going to do it.
Yeah, and if you haven't caught this in previous shows or other discussions that we've had, so the idea is when this happens, like if you remember, particularly, like we're not going to be doing alerts or specific, we're not building that into the system. Mostly because there's just too many unknowns.
Yep.
But what we are going to do is this sort of beta test where we take, and I say we, it's Jerry taking a chunk of his money and moving into that window so that we can test it out.
Yep.
Right? I don't know how many of your financial advisors are willing to take their own money and put into a beta test, but that's what Jerry's going to do. And so we're going to put that chunk over there, and then Jerry's going to play with that to see what can we use this for, right? Is it a tool for making more? Is it a tool for hedging? Is it a tool, there could be a lot of uses in there. And I'll guarantee you this, TSP or BlackRock or anybody else is not going to tell you how.
No, 100%.
That is not what they're going to do, right? What they're hoping is they open the window, 2 to 3% of people actually use it, and they can say that they gave you access.
Yep. And they want you to buy ESGs.
Right.
Yeah.
So you can lose money.
Oh, and so we are doing, so if you guys have probably seen it, we're starting a little Wednesday kind of midweek check-in
on the
Facebook
public
Live.
Yeah, public Facebook group, yeah.
And then we're doing every Tuesday.
Yeah, first Tuesday of every month at 5 p.m. Eastern. So every Wednesday, 2 p.m. Eastern, Jerry is going to take it out of his schedule to jump on live.
Yep.
It'll be kind of a free-flowing discussion. He might have a topic, and this isn't just for members, obviously. This is in the public Facebook group. Yep. We've got 17,500 people in there. So this is the way Jerry's going to try to engage with you, and so
some questions and answers, whatever. Maybe 15, 20 minutes. I'm going to throw up one chart that I think is kind of interesting for the week. Mm-hmm. Talk about that a little bit with respect to whatever.
And Jerry's not able to put the chart in the Facebook Live, so he's just going to throw it out right before he jumps on. It'll be in a different post, but you guys will see it there. So it's an opportunity to kind of talk and engage. But if you don't catch it live, you can still go in the comments and engage. But what Jerry pointed out is every month we're going to have these webinars where you can sign up on our public Facebook group. And we're going to tackle one of these topics. And the first topic
is what is happening with this tech refresh.
Yeah, and then we'll circle back probably 4 or 5 months later, and we'll do one about, hey, this is a midway point of what we're thinking, and then we'll do one, a year out. The webinars will be every month, but I'm just saying topic-wise, we'll attack it that way.
Okay. So inflation, the Fed, because everybody's talking about Fed raising rates and what does that mean and how does it affect our TSP? Okay. So this is a chart of the S&P 500 from 1965 to 1985 because these are the areas where inflation, this is the last time, right? Everybody talks about inflation in the 70s. This is what the chart looked like back then. The grayed out sections in here are recessions. Okay, so we had 4 recessions basically between 1970 and 1982. So there's a couple things to point out on this chart. Generally, the stock market moves pretty substantially lower before the recession begins, right? We had a peak up here. The market corrected quite a bit before the recession even began, and stocks went much lower, right? Same thing here. We had a peak. Prices come down quite a bit, and then the recession starts, and then prices keep coming down, right? It doesn't happen all the time. I mean, we didn't have a peak here, but prices did go down during the recession. We had a peak here, prices came down, recession begins, prices come down a lot more, okay? That's kind of the first thing to point out. The market rolls over before the recession begins. Also, generally, the market rallies when the recession ends, but it's usually in the middle of the recession. So the bottoms tend to be in the middle of the recession. So that's sort of the idea of there's blood in the street. Yeah, the economy is doing really bad. It's in the middle of a recession, and the market is bottoming. Okay. The problem is that the definition of a recession is 2 consecutive negative quarters, right? Negative GDP. So negative growth in the economy for 2 consecutive quarters. That's when the government says that the recession began. So stock market has already pulled back quite a bit at the beginning of the recession right here, right? It takes 6 months for the government to acknowledge that the recession began. By that time, stock prices are like down here. Then it takes at least another 2 months for them to look in hindsight and say that the recession ended. So it's kind of easy to in hindsight, pull up these charts and say, well, clearly there was a recession here and the market dropped, recession, market dropped. But in real life, it doesn't work that way because the government doesn't tell you that it began until 6 months after it began. So in my opinion, the best way to do it is to follow the stock price. Okay. So that's what the stock market, the S&P 500 looked like during, right, had pretty big correction here, very big actually. We went from 750 to 300, you lost 50% of the value of your stock funds. So what is the Fed doing? This is the chart of inflation. Okay, it's the rate of inflation change from 1966 to 1988, and these are the same 4 recessions from the last chart. Okay, so this is a monthly chart. We're going to flip back and forth between this one. This is the annual inflation rate, and this is the Fed funds rate. So this is what the Fed controls. When we say the Fed raises rates, they're changing the Fed funds rate. Okay, and this is a weekly chart. So this is a little bit more, you get more squigglies because it's weekly as opposed to this one is monthly. Okay. So here's what happens, 1970. Okay, inflation is increasing. The Fed is increasing rates to try to so the Fed has been raising rates. Once inflation starts to decrease is when the recession begins. And that's when the Fed starts decreasing the rate. Okay? So the Fed decreases the rate. The market, inflation bottoms. Inflation starts going up. The Fed is increasing rates to push inflation back down. It's the same cycle all the way through. Okay, you get the idea.
It's like a seesaw.
Yeah, the Fed is responding to what's going on in the market, right? It has a mandate to keep inflation low and to keep unemployment low. So,
so their idea is as it comes up, it'll start to push it back down. It'll start to go down and push it back up.
Yeah, it's trying to maintain equilibrium.
Yeah, and it's never going to be like this.
Right.
Because the system just doesn't respond that quickly, right? So, but that's what they're trying to do.
That's what the Fed's trying to do. It's financial manipulation to try to keep everything as stable as possible. That's the goal.
Yeah,
right?
Stability is the goal.
Stability definitely is the goal because that's what business wants, right? Corporate America wants to know. They want to be, and that's how earnings are created and stuff. Because everything forward looking depends on the basis not moving.
Yeah, the world wants stability, but the universe usually gives us volatility.
Yes, 100%. Yeah,
that's kind of the way it works.
To the Fed's credit, they have a very, very tough job.
Oh, it's
but it's also why everybody wants to invest here because it's way more stable here than anywhere else in the world.
Stability is at the end of the day, I think stability is way easier to kind of predict. Obviously, right? Volatility is not easy to predict. Right. So that's why people want to invest here.
Okay, so last slide about all this, and this is the one that has everybody very concerned right now. So the top is the S&P 500 monthly, so our C fund back to 1990, okay? And the bottom one is the Fed funds rate. So this is what the Fed can control, right? It moves the cost of borrowing money up and down. So we were coming out of a recession in 1990. The Fed was decreasing rates, okay? They were trying to stabilize it. So price was coming back up, but Fed wanted to make sure that price continued higher, so it kept decreasing the rate. Okay, they balance out down here. They're happy that the market's going to keep rising higher. In fact, the market does keep rising higher, and the Fed says, all right, we don't want things to get too out of control, so we're going to start raising rates. So they raise rates. The market keeps going higher. That's fine. Rates stabilize. The market starts to roll over. Right? Market tops out and starts to roll over at the top of the tech boom in 2000. That's back here as the Fed is still increasing rates. They figure it out. The market's rolling over. We need to decrease rates, and they do. Rates come down. Price comes down. Rates continue lower to try to put a bottom into stocks, right? And they do. Rates get down here to 2%. Market bottoms. Everything's great. Market picks back up. Rates keep going down a little bit as the market picks back up. Fed's happy that the market's moving again, starts raising rates. Price keeps going up. That's fine. Eventually, we get to a top. Fed sees that. Market rolls over. Rates decrease again. Same exact thing, right? We get to the bottom in 2009. Market starts going higher. What should have happened? The Fed should have started raising rates. It should have looked like this. They didn't do that. They kept rates at basically zero since 2009 until 2016.
Which so many people are used to as like their reality.
Their whole life.
Right.
Yeah.
Yeah. If you grew up during that time, you know, as an adult, like let's say you were 18 or 19, whatever.
Yeah.
Right. The whole point is, if that has been your reality of your financial life, you think that's normal.
Right. Right.
You don't know that it looks like that backwards.
Yeah. No, it's. I mean, I bought my first house, 95 back here. So the Fed funds rate.
Yeah. I did mine in 93, 94.
Fed funds rate is 6%. I paid like 7.5%, which Fed funds rate is the rate that the banks lend each other money. So obviously the loans that we get are going to be higher than the Fed funds rate. So my first mortgage on my first house was like 7.5%. And that was fine. There was nothing wrong with that. But 7.5%, you know,
people would lose their mind.
Oh yeah, yeah.
They would lose their mind.
Now, I paid 7.5%, right? I bought a $125,000 house. That house last year, when the rate was like 2.5% or whatever, was $450,000.
Right.
So inflation is one thing. When you say the price of the asset goes up, it's really not the price of the asset going up. The house is the house. The house was the house in 95 when I bought it. It's the same house today. It's the cost of borrowing that makes it seem like the price has inflated. So that's why, you know, in the definitions of it from Investopedia, it's things that you buy that are currency based. It's not about the thing that you buy. It's about how much it costs, how much the money is valued at.
Right.
Interesting stuff, I think. But anyway, so the Fed should have started raising rates back here as the market kept going up, and it didn't. Kept the rates super low. Finally started raising rates back in here in like 2016. Got up to about 2.5%. We had some churning here in the market, and it scared the Fed, and rates started going back down even before COVID, right? And then once COVID happened, that was it. They dropped the rates back to zero, stayed at zero until like last month. We had this giant move. We went from, almost 100% move. 2,500 to 5,000 would be a 100% move. We almost had a 100% move on the S&P 500, and the Fed didn't do anything to rates. It's insane.
Yeah, it's not normal.
No, it's.
I don't know if it's insanity, but it's not how we normally function.
Well, so here's
to maintain stability.
Right. So here's the last thing, and here's the problem. Right. Back here in 2007, let's just say, market was at a top. It was rolling over, and it was about to drop 55%. The Fed had all the way from 5.5% down to zero to play with, to goose the economy back so that we could put a bottom into the stock market. And that's how it was back here in 2000, right? We were up here at 6.5%, had plenty of room to help the economy as it was coming down to put a floor in there. We are at this ridiculous high right now, and the Fed is at zero.
There's no
right?
floor lower.
There's nowhere to go lower, and it's not going lower. It's telling you it's raising rates because it's so what's going to happen, right? I don't have a crystal ball, and this is the big thing on everybody's mind. If we're at a major top right now, and the Fed is telling us it's going to increase rates, what does that do to the price of stocks? It has to bring it down.
Yeah. I mean, it doesn't have to because it's human behavior, but it's the highest of probabilities that it's going to happen.
If a new something new comes into the equation, then something different could happen.
Right, maybe.
What that is,
we don't know.
Nobody has any idea.
Yeah,
I mean,
but based off that chart alone, if you don't see that there's a massive probability that we're going down a long ways.
There's a problem. I don't know how they're going to fix it, but they have a giant problem.
Yeah.
Fortunately, I don't have to fix it. They didn't give me that job.
Our job is to tell you guys what's happening.
I came off an airplane one time, and I saw Ben Bernanke standing at the top of the jetway, and I was kind of laughing. I don't know if he was waiting for his secretary or what he was doing, but I was kind of laughing because I walked past him and I'm looking at him I'm like, bro, you are very lucky I was not sitting next to you on this flight back from Amsterdam or wherever we were.
Because I would have turned your ear.
Oh, dude, he wouldn't have gotten any sleep on that flight.
Yeah. You were like, somebody get this guy away from me.
Yeah. He would have been. And anyway, all right. So.
And you would have been the guy you can't get away from.
That's what I was trying not to go down that road.
I know.
Okay. Bonus chart. I need a drink. Okay. BITQ is Bitwise. Bitwise is an ETF that seeks to track the total return performance of the Bitwise Crypto Innovators 30 Index. So the fund invests in securities of the index and in depository receipts representing securities in the index. Index was designed to measure the performance of companies involved in servicing the cryptocurrency markets. So crypto mining gear, all the stuff that it takes to go into the crypto industry. So it's a pretty broad index in terms of how is that overall crypto space doing. I pulled this chart because from a technical analysis perspective, it's pretty good. We were up here at like 33. So what is that? 16. It's more than 50% off from the high in November, right? Which is one thing. So it's past that 50% retracement level, which is where we really want to see it stop. It got support there at 14, right? Hit it 1, 2, 3, 4 times. And then this week clearly got below that line. So the whole crypto space right now, I'm staying away from it. This isn't the only chart we could look at, but it's almost like the S&P 500 of crypto. And it's a great example of where support failed. So it's just one way that you can use technical analysis. Okay. The TSP fund charts. So nothing's really changed. It was a very tough week. If you were trying to get in and out this week, if you're a paid subscriber, you certainly know what I'm talking about. But if you are looking at the TSP funds on a weekly basis, we've been talking about this a lot. Here's the low in COVID. Ever since price got back above that 20-week moving average line, every time it corrected down to it, it got support until January, where it broke through. And then almost every time after that, it couldn't get back above that line. It was above it here for a couple of weeks and then rolled over and can't get back above it. So no point in being in the C fund. I shouldn't say there's no point in being in the C fund. The point of this chart is to say that until price gets back above that 20-week moving average line, it can't go higher. It can't go to all-time highs. So, could we get support down here? Would this be a buying opportunity? Yeah, maybe. But until price gets back above that trend line, that moving average line, we're not going to new all-time highs.
Yeah. And we normally play around a little bit with kind of, it's not really hedging, but it's just the best we could do at TSP to say, like, I'll take 25% of my portfolio or 50% of my portfolio and I'll jump back into the C or S, right? Yep. Sometimes we'll do that to see, like, okay, maybe there's an opportunity for gains here, but I'm not willing to put all my money on the table, right? And so I think a lot of times folks that are following us, it's an all-in or all-out mentality. Yeah. And you don't have to play it that way. Right. But you do, if you're going to play it at all, you do have to make the educated decisions, meaning that, if you go back and look on our website and you'll see certain allocation spreads, we might have 25, 25, 50. Mm-hmm. We might have, normally we don't go much crazier than that. There's 30, 30, 30 or whatever, Right. The point is there's nothing wrong with kind of spreading it out, because what you're doing is kind of hedging a little bit as best we can do to say, okay, I'm not willing to go all in, but I do want to get a little gains, right? And that has fared well for us over the decades. Yep. And so, again, you have to put it in perspective, right? So you're never going to catch it perfect, but if you can get a little gains here and there, and then the big swings are what our methodology works best with, right?
Absolutely.
Yeah.
S fund, same kind of story. Yeah, S fund's having a rough go of it. Once it got below, it really broke below that line in November. Hasn't been able to get above it ever since. We got some pretty serious support down here at 1,800, and it looks to me like that support has very little possibility of holding, but we shall see. iFund, same thing. And also we're below 50 on the RSI. So you want to see price get back above the blue moving average line and RSI get back above that 50 line. F fund is a complete disaster. Now, there are a lot of people right now that think that we have hit what's called peak inflation. And there's peak inflation. The Fed responds to push inflation down by raising rates until something breaks. And when they say something breaks, it means the stock market collapses. Mm-hmm. And so there's a lot of smart guys out there that are starting to sort of call it dollar cost average. They're starting to dip a toe back into bonds because once the Fed says, all right, we've done enough, the market's going to take off. And it's probably going to whether it takes off and keeps going to new all-time highs, that's one thing, or we get a huge relief rally, that's another possibility. But the AGG, the F fund right now is like 4 standard deviations from the mean. I don't think it's ever been there.
That's not a good thing.
No, it means it's so undervalued. It's never been this undervalued. So if you want to kind of take a chance at it, this is like catching a falling knife when it's clearly, there's no better example of a falling knife than that. But it's fallen so far so fast. It's 4 standard deviations from the mean. This is the example of blood in the street. Mm-hmm. If you have the courage to get back into the F fund at this point, you're probably going to do pretty well.
Yeah, but the only problem with the not the only problem, but a problem with the F fund is that you're not going to get these massive gains if you do catch it. Right. If you do catch the knife at the bottom, you're not because it's the F fund. There's not big swings exponentially, right? It's not like the CS and I.
Right.
Yeah.
Right. Yep. All right. That is all I got. If you're looking for more real-time analysis, definitely consider becoming a member. Of course, members get the newsletter. We go into much greater detail. We're doing the 2-year weekly charts here in the newsletter, usually there's 6-month daily and sometimes intraday charts.
Yeah.
And so
we go way more into the weeds in our newsletter. I mean, I say we, Jerry does. Yeah, guys. So if you have questions, wherever you find this video, whether you find it on YouTube or Facebook or, on our website, whatever, if there's not a comment section where you find it, then you can shoot us an email, support@growmytsp.com. The support folks will forward over to us, and we'll get to it. So, look, if you're getting value out of this, please share it with your friends, man. We love it. Yeah, it's been fun. We've been doing this. I don't even know now. I've got to go back and look and see. It's like a couple years. Yeah, it's getting close to a couple years. We just kind of do it every week, and we don't think about it. But it's been a while, and so if you guys are liking it, give us some feedback. It's always nice to know if anybody's listening.
Yeah, 100%.
All right, guys. Hope you have a great week, and we will talk to you later.
All right.
Cue music.